If I told you I buy shopping malls for a living, what's the first thing you'd think? Probably that I'm crazy. Malls are dead, right? Amazon killed them. Here's the thing, you're half right. I bet about 700 malls did die, but what happened to the ones that survived is a completely different story, and almost nobody is paying attention to it. In this video, I want to walk you through the 5 biggest misconceptions about retail investing and show you where the narrative breaks down. Because when perception and reality diverge in real estate, that's usually where the opportunity is. Let's start with the obvious one. Myth number 1, malls are dead. Now, I'm not going to spend too much time here because I've already done a full breakdown on this subject. If you want the deep dive, go watch my video, The Truth About America's Zombie Malls. But here's a short version. Retail didn't die, it's split. High quality malls are still productive, still leasing, still driving traffic. Lower quality malls are the ones struggling. The US peaked at about 1,500 enclosed malls in the mid-2000s. Today, we're down to somewhere between 700 and 800 malls. The malls that died were overwhelmingly Class C and Class D properties, built during the 70s and 80s construction boom, when developers were racing to put a concrete box in every suburb with a pulse. The surviving 700 to 800 malls are a fundamentally different asset base. This is a Darwinian filter. What made it through is stronger, better located, better capitalized. This is what industry research consistently shows, a bifurcation between top-tier assets and everything else. So the real story isn't that malls are dead. It's that the gap between winners and losers has widened. Myth number 2, e-commerce and Amazon, they killed brick and mortar. Again, I've done a full video on this called How Amazon Changed Retail Forever. If you want the full evolution, go watch that after this video. But here's what actually happened. E-commerce didn't replace stores, it changed how they're used. Today, retail is omnichannel. Stores are no longer just places to buy things. They're showrooms, fulfillment centers, return hubs, and customer acquisition channels. Retailers that integrate physical stores into their distribution strategy often outperform pure e-commerce players. And even today, over 80% of retail sales still happen in physical stores, according to US Census data. So the idea that Amazon killed retail is just not true. What it did was force the industry to evolve. Myth number 3, retail is a dying asset class. This is where perception really diverges from reality, because if you actually look at the data, retail fundamentals today are surprisingly strong. Vacancy rates in U.S. retail are near historic lows, according to JLL and CBRE market reports. Average occupancy for Class B properties and above are in the mid to high 80%, and it's been ticking up, not down. Sales per foot is rising. Net operating income at non-distressed properties is growing. Green Street's data confirms it. That's not what a dying asset class looks like. Dying asset classes don't produce rising occupancy and growing NOI. At the same time, new retail construction is extremely limited, virtually non-existent. Developers simply aren't building new shopping centers or malls at scale anymore, largely because construction costs are too high to justify the returns. So what happens when demand stabilizes and supply stops growing? You get tightening fundamentals. In other words, retail isn't dying, it's actually becoming supply constrained. Myth number 4, retail's too risky. This is probably the most important one from an investment perspective, because this belief is what drives pricing. Retail trades at significantly higher cap rates than most other asset classes. Malls and shopping centers can trade anywhere from 8 to 16% cap rates. Compare that to multifamily, which often trades at 4 to 5% in many markets. So investors look at retail and say, hey, it's risky. But here's the key question. Is it actually more risky, or is it just priced that way? Because when you buy it at 12% or 15% cap rate, you're getting paid for that perceived risk. you've got margin, you have yield. And in many cases, you have downside protection that lower yielding assets simply don't offer. Also, a large portion of retail tenants are service-based and e-commerce resistant. Think about it. Restaurants, gyms, medical users, personal services. These are businesses that can't be replaced by Amazon. So the risk profile of retail is often misunderstood. It's not that risk doesn't exist. It's that it's being compensated differently. And that leads to the final myth. Myth number 5, retail doesn't grow. This is the quiet assumption behind everything else. Even if retail survives, people assume it's just a yield play, no upside, no growth. But that's not how it actually works. Strong retail assets can grow in multiple ways. Rents can increase as tenant demand improves. Vacancy can be reduced through better leasing. Tenant mix can be upgraded to drive higher sales per square foot. And in many cases, you can reposition or redevelop underutilized space. On top of that, there's a potential for cap rate compression. If sentiment shifts even slightly and retail cap rates move from, say, 12% to 8%, that alone can drive significant value appreciation. So the idea that retail has no upside ignores multiple layers of growth potential. And when you step back and look at all 5 of these together, you start to see a pattern. Malls are dead because e-commerce killed stores. So retail's dying, which makes it too risky. And even if it works, there's no upside anyway. Each one of these ideas sounds reasonable on its own, but together they create a narrative that's simply not supported by the data. You've got an asset class where supply dropped by half, no new supply is coming, and survivors are posting improving fundamentals. In any other sector, people would be falling over themselves to invest, but they're not. And that's because public perception is still anchored by the 2010 to 2018 narrative. Every business magazine was running death of the mall cover stories. Pension funds and endowments adopted blanket no mall policies. They hard-coded it into their investment mandates, and they never went back and updated them. That kind of reflexive avoidance is exactly the condition that creates mispriced assets. When an entire investor class won't look at a sector, the people who do look find less competition and better pricing. We're not arguing that every mall is a good investment. Selectivity matters enormously. But the blanket dismissal of enclosed malls as an asset class doesn't hold up against the actual operating data. The malls didn't die. They went through a brutal filter, and what came out the other side is leaner, less competitive, and generating real cash flow. You don't need retail to become the most loved asset class again. You just need the narrative to shift slightly, closer to reality. Because when perception catches up to fundamentals, pricing tends to follow. And that's where the opportunity is.